Think beyond traditional business banking. Think a partner that gives you in-depth financial insights.
Well, if you have just joined us, so you are watching the Power Table on Power Lunch Southern Africa. And the agenda on today's Power Table is South Africa's economy. And we're asking whether it's losing its resilience or if the contraction that we did see in the third quarter is just a speed bump in its road to recovery. I'm joined by Carmen Nel, the head of multi-asset strategy at Terebinth Capital, as well as Elna Moolman, head of South Africa Macroeconomic fixed income and currency research over at Standard Bank. Ladies, to the both of you, thanks so much for your time. But Carmen, let me begin with you. I mean, we do know that our economy hasn't been shooting the lights out for some time now, several years, but it is also significant that the contraction that we did see in the third quarter was the first contraction this year. And therefore, I'd like to know if this is a sign that perhaps the rubber of South Africa's economy is starting to lose its elasticity right now, or if we have just hit a pothole and the road to recovery that we were promised by this government is still on track.
Well, I think in broad terms, if you look at underlying growth in SA, it's been going nowhere slowly for quite some time. We had a bit of a positive terms of trade shock, and that's unwound. So I think this is a clearer picture of a combination of ongoing supply side constraints, as well as now a bit of demand side weakness. So I do think that the tightening in monetary policy is having an impact. So I wouldn't necessarily just call it a pothole. I think there will be a recovery in Q4, but there was broad-based weakness because of a culmination of factors, and it is going to take some work to correct some of those heading into next year.
Okay. Elna, what about you? I mean, I do know that in some parts of this country, the potholes are pretty big and pretty deep. In fact, they're the kind of potholes that can actually write your car off the road. So is that what we're potentially looking at right now in terms of the position that South Africa's economy finds itself in? Or is the first contraction in the economy for the quarter for this year just that, and the road ahead is potentially looking better?
Yeah, so we do think that the road ahead is a little bit better. My growth forecast, for example, for 2024 is a little bit better than for 2023. In the third quarter, we did have a significant contraction in the agricultural sector, down roughly 10%. So that was one specific factor that impacted on the numbers. But I think if we take a longer term view, whether we look at it, let's say, since the beginning of the pandemic, or even if we take a little bit of a longer term view, then it almost seems to me as if we're seeing a little bit of a divergence. Like Karen was saying, almost no part of the economy is really shooting the lights out, but there seems to be a bit of a divergence between the goods producing sectors in the economy and the services sectors in the economy. Now, we'd assume that the goods producing sectors, mining, manufacturing, for example, would be more directly affected by the infrastructure bottleneck. So we're thinking specifically about load shedding, ports, railway problems, etc. And there it's clear it has at best stagnated, and there's probably even a little bit of a downtrend. The services sectors are doing a little bit better, but still, even if I compare it to prior to the pandemic, it's up roughly only 2%. So at least it counteracts the weakness in the goods producing sectors, but it is really a very uninspiring growth story at this stage.
Sure, because what was also significant in this set of numbers was the fact that we've seen the first is a decline, and Carmen, you can correct me there if I'm wrong, but we've seen the first decline in fixed private and public sector investment or gross fixed capital formation in 7 quarters. In the previous 7 quarters, that number was on the up, and right now it looks like the brakes have been put on that. And I'd just like your thoughts and your thinking on how we should interpret that.
Well, I mean, as you say, we've had a series of quarterly increases, so that already speaks to some rebuild in terms of capex. And then we had a very strong Q2, so second quarter outcome in terms of gross fixed capital formation. So I think it should be seen in the context where, in particular, some of the impetus from renewables and home biased solar That's sort of happened now, and you've had a bit of a pullback there. So I wouldn't read too much into it directly. I think certainly one should expect gross fixed capital formation to be a positive story for next year. The question really is whether the Transnet or logistics side can also play ball. So I think electricity for next year should be a positive. And that is obviously partly related to actually delivering on some of the promises ahead of the 2024 elections. But then, as Elna said, on the production side, you really need the transport infrastructure to come through, and that might take a bit longer. So maybe the big delta in terms of fixed investment people we're expecting for next year might be a bit more muted and more maybe longer lasting, because as electricity is addressed, then we address the Transnet issue. You can have a bit of a longer growth trajectory coming from that side. So I wouldn't read too much into one quarter's fixed investment data.
Okay, Elna, what about you? I mean, did anything stand out in terms of what is happening with gross fixed capital formation this time around?
Yeah, we don't really have all of the detail in this data set, but I think the key story here was electricity-related capital goods. So in the second quarter, we saw an absolute surge in electricity-related imports and investments. If I look at, for example, solar panels, we imported roughly 25 billion rands worth of solar imports. If I look at the May data, for example, if I could express that at an annual rate, in other words, if we repeat that for 12 months, it's 25 gigawatts of solar panels. Now, that was clearly going to be unsustainable. So it was a shock reaction to the shocking extent of load shedding that we saw since the end of last year. So to my mind, some normalization was to be expected. I've already mentioned 25 billion rands of solar in the second quarter. It declined to 11 billion in the third quarter, but that's still double what we did per quarter last year. So it's still a bullish story. The investments continue. It's just not at those unsustainably strong rates. But we then also have to say the other side of that coin is that imports are declining. In other words, we're importing less solar panels and batteries and so forth. And so that then gives us a little bit of relief. And if there is one positive story, I think that the current account is not going to be as negative as many people feared at some stage. At some point, investors were saying 3 to 3.5% of GDP this year. And it's increasingly clear that is quite unlikely.
But maybe the counter to that could be that it could be a lot better if a lot of the goods that we're making here and we want to get out to the rest of the world were able to go out to the rest of the world, if we didn't have some of the challenges right now around the transport and the logistics arena. And I want to ask the both of you about that. And Elna, if I just come back to you, because of course we recently did hear that the National Treasury had approved a form of guarantee or rescue package or support system for Transnet to help it get itself back on track. And I just wonder whether you think that this is a positive development. And also, I mean, just given the fact that you do have a former mining executive, respected executive, who is chairing the company right now after leadership changes, whether you think this also potentially inspires confidence of Transnet getting back on track sooner rather than later.
I think what's important is we should almost see the logistical challenges similar to electricity. In other words, it took roughly 1.5 to 2 years to really see the response to the reforms in the electricity sector. And it will be the same in logistics. I'm very encouraged by some of what I'm seeing in policy circles. I'm encouraged by the dialogue between private and public sector. I'm encouraged by some of the interventions. It's clearly becoming a priority, but we should also be realistic and say, you know, there's a limit to how much we can do quickly. And real material sustainable improvement is going to take some time. I think the Treasury support is very interesting. If Treasury gave Transnet nothing, it would have been quite difficult to foresee any improvement. I think the mechanism by saying we're going to give you guarantees rather than absolute injections is a very strong signal that government is trying to push Transnet towards saying your only alternative is to get more private sector as part of the solution. So again, some parallels between logistics and electricity. We knew that Eskom couldn't solve all of the electricity problems. We needed that private sector investment in electricity generation equipment, the solar panels and so forth. And I think the story is similar in logistics. Transnet isn't going to be the solution to this problem. It has to be part of the solution, but we will have to see more private sector participation as well. And I think Treasury is clearly trying to push this in the direction of saying sooner rather than later, get more of the private sector in to help solve this problem.
Sure, and of course we have seen a bit of that happening, particularly private sector players coming from outside of the country, partnering with Transnet on a few of its lines. It will be interesting to see if we have more of that kind of activity just following this guarantee, and whether maybe more domestic players have appetite to also step up to the mark. Carmen, let's circle back to agriculture, just given the fact that we did see the biggest contraction happening in that space. And I just want to know, in your view, how worried we should be about something more deeper and more protracted going on right now. I mean, on the one hand, we do know that the agricultural sector was our cushion throughout the pandemic. It was one of the sectors, one of only sectors that managed to grow in a pandemic and also managed to add jobs. This year hasn't been so great. I mean, we're looking at almost 10% contraction in the third quarter, coming off a 11.9 or almost 12% contraction also in the first quarter. There's a whole host of things that are affecting agriculture, not only some of the logistical challenges that the both of you spoke about, but we know weather-related challenges with this El Nino, broader climate challenges regarding adaptation of the sector as well and resiliency. How worried are you about what's happening in agriculture right now?
I think if we just look at, well, there are a few things. There's one sort of highly technical issues around how Stats SA does the agriculture component of the GDP, which often can then lead to these supposedly surprise increases or declines. I think the third quarter showed a bit of a lagged impact to the increasing load shedding we had in Q2. So pretty much then, because you had irrigation problems, etc., the shortage really came through on the production side only in Q3. We also had the bird flu, so the avian flu, which also then hit supplies. I think underlying, if we look at sort of the grain sector, etc., that's still quite robust and resilient. You know, still very good yields, large harvests, adequate supplies, adequate inventories. So I don't think there's a concern. El Nino, yes, there is an El Nino. I wouldn't necessarily say it's a particularly strong El Nino. If you look at some of the updates, that the El Nino is expected to actually weaken over the course of the next, let's say, 5 to 6 months. And it's not always a guarantee that if it's an El Nino year, that we have below average rainfall or drought. So currently it does seem as if the grain side is doing fine. Obviously, longer term, we have to worry about climate change, ensuring sort of innovation to keep yields high, but we're not a food scarce economy, unlike many other African economies. So in that sense, I think if we at least don't score too many own goals on the policy front and deal with things like logistics to get exports to market, which again helps profitability in the sector, you know, one can be optimistic within the typical, you know, climatic or weather-related swings we should see in the short term. So I wouldn't read too much negativity again into this Q3 number as it relates to agriculture, because we know why it was weak, rather than it being something that necessarily has to continue in the coming quarters.
Okay, so what does that mean? That means growth in the fourth quarter and thereafter for agriculture?
Well, again, there's certain technicalities that are underlying it. So I wouldn't be surprised if we have some sort of technical decline again in Q4. But I do think on many fronts, you are coming off now a weak third quarter base. If you look at, for example, the PMIs, those have actually increased, both the manufacturing as well as the whole economy PMI. So that is a positive. I think a partial offset for Q4 might come through from weaker Black Friday sales. So what you've actually seen is sort of this notion of residual seasonality in the data over the last 5 to 6 years, where Q4 GDP is boosted by Black Friday, where people postpone spending from Q3 and actually bring forward spending from the first quarter. So that, I think, will help Q4, the fourth quarter expansion, but it might then be softer than, say, a year ago if you look at some indications around the volumes related to Black Friday sales. So I would say we could probably look at an expansion in Q4 of, 0.5%, 0.6, 0.7. That'll put, full year GDP at something like 0.6, 0.7%, which is actually not far off the mark that a lot of people had, in the middle of this year. So if you look at something like, various consensus surveys, I think full year growth is expected to be about 0.7%, which again is going nowhere slowly. So it's important that next year at least, growth picks up above 1%.
And Elna, you did mention that you are more positive about growth for 2024. Positive enough for it to pick up beyond 1%. And that is not actually the question I wanted to ask you. The question I actually wanted to ask you is whether you are seeing evidence and real tangible evidence of the reconstruction and the recovery plan starting to work in this economy such that we do get growth above 1%. I think growing above the population rate in this country right now.
So I expect about 1.4% growth. So at least, like you say, relative to 1%, slightly better than this year. It's still very weak, but it is important whether we see a little bit of an improvement and then hopefully in 2025, an additional increase. Now, there are a couple of factors behind that. We expect the inflation to decline a little bit, so that provides a little bit of relief, at least for consumers, with wage growth then in real terms at least positive. And we think that the Reserve Bank will, like many other central banks, start to cut interest rates. And so that should also provide a little bit of relief. We're not too focused on the reconstruction plan and the exact interventions there. What we're rather monitoring is Operation Vulindlela, because I think that's quite instrumental in creating the space for the bigger reforms. And again, I have to go back to the electricity sector where people were extremely skeptical about the reforms. I remember extreme skepticism that the private sector would respond. It took time, but it happened. But we have to think about it in these big intervention terms. In other words, that was electricity. By next year, we expect load shedding to be far less of a constraint. We're starting with the logistical sector now. It will probably also take at least 18 to 24 months before it is meaningfully better. But we are then addressing these big growth constraints one by one, and that gives us some comfort that we're on our way to better growth. 1.5% is still not nearly enough. We need more than that for just unemployment and government debt to stabilize, but at least we are moving in the right direction.
Sure. So, I mean, the name of that big reform package of the government essentially translating to opening the way or making the way for brighter days, clearly rightly named and working. Could be better, but working right now. So here's the thing. I mean, you ladies know better than me. Every year we start off the year with very ambitious, in the South African context right now, growth targets, and ambitious being over 1%, which is actually a low bar, but it's better than the 0. What's that we're talking about right now. And what we see throughout the year is those growth targets being revised lower because of a whole host of things that happen that we don't expect, that are beyond our control, sometimes own goals that we score. So, Carmen, it's a question around the major risks then to the growth outlook for 2024 as you see them. What are they?
Yes, I think Elna mentioned sort of the positive factors that should help growth. Another one that'll help sort of back in spending a little bit, but because of the delay now, was going to be the two-pot system. So I think that would have given GDP a tiny bit of a spurt, but that will only be implemented from the 1st of September. I think the big risks really stem from offshore. So we know what the local risk factors are. It is if Eskom doesn't get sorted out and if Transnet doesn't start dealing with its problems, we know those things could continue to weigh on growth. Whereas if we look at a lot of, or the forecast for most countries for 2024 is to have slower GDP growth versus this year. So we are facing now an environment where demand potentially, or demand growth for our exports, will be weaker next year than this year. So that is a potential headwind. The other risk factor, obviously, is that you have a hard landing in the US that spills over. So that could also weigh on growth. And another one stems more than from market volatility is currently global markets are, arguably priced for perfection. So you've got this expectation now that the Fed's going to cut by at least 100 basis points next year, the ECB by at least 100 basis points. So markets are pinning their hopes on sort of this dovish pivot. And if heading into next year, US inflation doesn't fall as expected, and the Fed's sort of forced to resume the hiking cycle, that's a big risk factor in terms of small open economies like South Africa, who are reliant sort of on foreign capital flows in terms of our savings constraint, as well as reliant on offshore growth for our exports.
So I mean, I'm glad that you mentioned the two-part, and you mentioned the new deadline now being September 2024. Again, we'll have to wait and see if that is set in stone or if that's moved out. But that speaks to an initiative that many are saying a lot of consumers need right now because of the fragile state of the economy and the fact that we have a lot of companies, particularly in the mining sector, announcing mass job losses that will impact the state of the consumer. So, Elna, just your thoughts then on the state of the consumer, but more specifically the expected rate cuts for South Africa's economy. What if we don't get them, or we don't get as many as are priced in right now? What happens to the consumer and their contribution to GDP then?
It is a concern. If we don't get those rate cuts, we'd have to rethink the growth that we can expect to see next year. At this stage, I'd still argue that the risks are that we get the rate cuts a little bit later than we expect, rather than not getting them at all. But you are now talking about the risk scenario. I would say the consumer story is extremely uneven. We have a lot of data looking at Standard Bank's clients, but also all kinds of other data from Credit Bureau and income sources, etc., that tells us it's a very uneven story, that the high end is generally, and it is a generalization, still in a reasonable financial space. But there is undoubtedly pockets of the consumer space, particularly low income groups and low middle income groups, where the pressure is quite severe. You've touched on the employment risks and negative pressures there, but we also have to say in the latest employment data, we have seen a little bit of a recovery. It's still a lagged recovery, so firms probably hiring as almost a catch-up effect to the GDP recovery that we've already seen. So we're at this stage still hoping that that will counteract the announced job losses in, for example, the mining sector.
Yeah, one can only hope. But you talk about the resilience of the well-to-do. It was interesting to see that in some of the data around Black Friday and their spending habits, that luxury goods were not the fastest things to go off the shelves this time around. I don't know what that speaks to, whether it speaks to the middle class who aspire for luxury goods not being able to be in a position to afford so this time around, or if it speaks to the luxury good consumer themselves not being in a position to buy during Black Friday, or having all the stuff already and not needing to. But to the both of you, thanks so much for your time. Really interesting and insightful insightful conversation on the state of the South African economy and what we can expect. I do hope that you are right and that 2024 does pan to be a little bit better than 2023. That's Carmen Nel, the head of multi-asset strategy for Terebinth Capital, as well as Elna Moolman from Standard Bank.
This program is in partnership with Nedbank Commercial Banking, a banking partner that thinks bigger to guide your business growth.